Today is Monday, 14th of May 2018, and here we are on the S&P 500 index. Okay, so my last update was that upon this spinning top, and which squared out at a 60-day cycle, I was looking for lower prices to print, which we had. I said we have to keep an eye on the 200-day moving average, because as we can see here on the first breakdown, and then again here and there, and then on Thursday, May 3rd, 2018, the algorithms via institutions and probably central banks have bounced off it and have propped up this index. Same with the Dow Jones as well. So my last call was I was looking for a bearish 1, 2, 3 ABC or 3-wave down pattern with a target of around 2490 area. Obviously we didn't get that, so what happened? Well, for those who are familiar with patterns, especially the combination of the free wave pattern, the ABC, and then when we get the ultimately the failed last leg of the pattern, and then it moves in the opposite direction, goes this way, is what happens is a failed bearish pattern in this instance actually becomes a bullish Gartley pattern. And the difference is, as I just stated, it's the failure of the last leg down when it reverses up. Now, delete that. The general rule is with the bullish Gartley pattern is the bullish, in this case because it's bullish, the last low to high, the rule is that should equal the first move down from high to low. So if we copy that measurement via the arrow, it's saying that the top of this last leg up in this bullish Gartley pattern will move the S&P back to its high of 2868, which would fill that runaway gap. Now, first of all, I wouldn't be getting too carried away and excited about this move. There's a lot of obstacles to overcome here. We have a cluster of Fibonacci measurements here, which could act as pretty solid resistance. Currently, the futures at the moment, it's testing that. It could very well, as it usually does, what they usually do early in futures trading is that they pump it, then they slowly drip feed it down. So this could very well be a false signal of a sell-off coming later today. So that's the first area I'd look at. Also, there's a lot of market participants, technical analysis, saying it's broken the descending triangle. We maybe move to the weekly, which gives us a better picture of things. Some are saying it's a descending triangle or a wedge, whichever way you tend to measure these things. So if we go from the top here, from there we can see currently last week it broke it, and people saying this consolidation, this correction period's over, and ultimately we're going to get higher prices to print. Now, I'm not getting carried away with this just as of yet, because we've got a few timing cycles coming up. We've got one on Wednesday this week, which is a 90-day squared cycle. If I just pull this chart down for a second and open the other chart, open this one. Now this chart actually includes the futures trading. So obviously we get a different price action, and currently we can see if we move to a 4-hour, we're getting the futures, which is currently at 27.43. So if I just switch back to the daily here for a second. That. Across there. Now, what we can do on this one, we can even count this. What I'm saying, this is where, as I said, I'm not getting too carried away with this continuing to run up and make an attempt of the high back in January, because here we have a bullish, if we count it from here, an ABC, which we have exact harmonic moves from this one to this one, which measures out around 27.55. Now, these are never equal in length. They can overshoot or they can undershoot. As I said, once again, I'm looking at the area of 27.40 as a major area of resistance. 16th of May is a 90-day squared cycle, so we could very well get a rally today and tomorrow, but I'm looking at Wednesday for the end of this leg to terminate and a corrective retrace to go back. Now, looking further ahead, where are we possibly going to move with this? Now, if I just pull that one down again and go back here, if we switch to the monthly chart, find it interesting with these patterns. As we can see, if we look at back in August of 2015, when we had that bit of a panic sell down, and then we had a rally, and then it stalled, and then we got another move lower. To me, it looks like we could possibly have a reoccurring pattern occur here. So we've gone there, there, there. See how we get these patterns that seem to always repeat? So we could very well get a move possibly high near the, closer to near the top, and then we get another pullback low, which will mimic that exactly. Now, we'll just switch back to the daily chart for a second. Supposedly the reason that caused the initial panic sell down from late January through early February was when the 10-year yield reached over 270 basis points, and that caused a panic in the market. Now I find it just a bit extraordinary that, as I said, all the market participants are bullish, but we still, if I just move this for a second over, we still have the 10-year at 296. So, and then we compare it to the 30-year is at 310. We've got a what they call a flattening yield curve between the 10 and the 30-year. So the point I make is, if when the 10-year hit 270 caused this panic, we've got a high yield at 296, and they're saying that the market's okay with this and allowing prices to move higher. Personally, I'm very highly skeptical of that, for the fact that unless they really buy up bond prices and push that 10-year back down to the 250 area, to support this market. If anything, I personally think that the 10-year yield is going to test and go over 3% again, which would completely invalidate a higher move. So currently at the moment, with what's in play, I'm neutral. I'm on the side. I'm not taking trades at the moment. I'm just looking at certain levels to play out. But I am leaning more towards another move lower, and possibly, obviously, a test of the 200-day moving average again. Now, for those who are familiar with a Gann method, Gann had this rule he called the rule of 4, and basically it is let's put that in there. So we had one test, the 200-day moving average. We had a second test. We had a third test there. And Gann ultimately said it's always on the fourth test of either a key support, and we've got to, obviously we deem the 200-day moving average as a major support, but Gann always constantly said that upon the fourth test is the one where it's going to either break a support or resistance. So the point I make is that if bond yields don't drop, so if the 10 years still remains at these elevated levels and even possibly goes over 3%, and then we get another big retracement back with the 200-day still on an incline move up, I think looking at Gann's rule of 4, we will see upon the fourth test actually confirmed break, and that's when I think once we get the confirmed break we can see an acceleration to the downside. So anyway, that's my call for the S&P 500. As I said, I'm neutral at the moment, but I am looking at levels just a bit further up around the 2740 area to 2745 area as areas of resistance to possibly mark this end of this C wave up on the other chart, which I'll just pull up to mark the end of this. And then if that resistance and those Fibonacci measurements hold and square out with a 90-day cycle count, and we get a rollover, that could possibly mark the end of this bullish C wave on this chart higher, and then we can see possibly a move lower. And that's my call.